going to talk you through some fundamental analysis trading secrets. This video is designed to be friendly to those of you who are completely new to fundamentals, although you might not necessarily be new to trading. So a lot of the traders that come to me for coaching are actually fairly advanced in technical analysis, but a lot of the time they may be complete beginners at fundamental analysis. So even though they know the technical analysis side of trading through and through, and they're even experts in that area, they're still struggling to move forward and to cross that bridge into a profitable trader. And they often feel like there's a missing piece to the puzzle. So if that's how you're feeling, then this video is for you. So in this video, I'm going to tell you why fundamental analysis is so important. It's often the missing piece of the puzzle, as I mentioned before. Fundamentals is what moves the markets, not price action. Technical analysis is the visual representation of the movements of the market, but often it can be confused for being a leading indicator, whereas actually it's more or less it's showing us past data. If you really want to get an edge in the market, you really want to be understanding the fundamental side of it. Fundamentals affect the short and the long term. So obviously if the market is doing well, if it's doing well on the long term, you're going to see that there is a long move up, but also it really affects the very short term, the very immediate. So when a news release comes out, you will see a big spike in the market on the 1 minute time frame. So it really affects the short and the long term. So it's really important to understand what's coming out, what's important, and when it's coming out. There's going to be a beginner's cheat guide, so I'm going to be telling you which economical events you want to be the most aware of and where you're going to be finding this information. The trading secrets, they're more like tips really, but I like the word secrets because I got bored of using the word tips so often. But yeah, I mean, they're going to be 5 fundamental analysis trading tools, secrets, things that I have found very useful from my time being a trader and looking at the fundamental side of it. And in a minute, I'm going to go through and tell you where I got this information from and a bit about myself, my background, and my training. At the end of this video, for those of you who are hardcore, there's going to be a free gift, which is going to be a cheat guide, which you'll be able to download and print, and it will be able to help you with your fundamental analysis. I've also included a nice little screenshot of a trade that I placed this last week, which was based off a news event. And it was mainly to highlight how powerful it can be when you understand the fundamentals, because this move was overall, it was a 600-point move on the US 30 or the Dow Jones. I managed to get about 350 points. That was in a sell position, but it was from understanding a news release which had come out earlier that day. And if you are fluent in these news releases, it's going to be a lot easier for you to not only get into these trades, but also to understand when they are likely to come out in the trading day, and it will give you the confidence to hold them. But first of all, before we get started, if you are new to this channel, then welcome to Trading Angel. My name is Caroline. I'm an indices trader, so I trade the Dow Jones and the Nasdaq in the New York session. I did actually start on Forex, but since going into the US indices, I've never looked back. They're just the right markets for me. So this video, I will obviously be making reference to the Dow Jones and the Nasdaq, as that is what I'm trading myself. But if you are trading Forex or if you're trading any other markets, then this video is also going to be useful for you because you can still use the principles that I teach you and just apply it to the markets that you're looking at. I've been trading since 2015. I've coached other traders since 2019. I've coached over 100 traders one-to-one. I've also been coached by institutional traders, and this is quite important for this video because it was my training with the institutional traders which actually kick-started my journey into fundamental analysis. Before that, I was a technical trader, and my experience with trading was that I was doing really well. I had a good strategy and I would be making consistent wins, but then when a news release came out, I would lose all of those wins and I would make huge losses. And also I didn't necessarily understand when those news releases were coming out, and I wasn't aware to be looking out for them. So I signed up for coaching with institutional traders because I identified that that was a huge gap in my knowledge, and that was actually where the majority of my losses were coming from. It wasn't from my strategy, it wasn't from my technical analysis, it was from my lack of knowledge in fundamentals. And since learning fundamental analysis with institutional traders, It's made all of the difference. And now I am a firm believer that actually you need both of those in your trading. I know that's an unpopular opinion and no one wants to believe that you do need both, but for me, I couldn't possibly understand how to go about the trading day without taking both into consideration. I've also recently taken a DIPFA qualification at level 4, so that's a Diploma for Financial Advisors at the London Institute of Banking and Finance. I took that a little bit because I'd started this journey of going down the fundamental analysis route with the institutional traders, but also because I enjoyed it so much and I saw how powerful that was and what a big difference it was, I really wanted to build on that and I wanted to have an official qualification. And I potentially want to work in the future as a financial advisor. However, I do want to make the point that I am not currently working as one and have never worked as one. I've just got that qualification. So nothing in my videos should ever be taken as personalized financial advice. It's just to let you know that I've taken a qualification to a certain level, and that's where a lot of my knowledge has come from. So why fundamental analysis is so important. So I know this is an unpopular opinion, and there are going to be so many traders who are going to argue either side of this. There's going to be traders that are going to say that you can just be a technical trader. And there is some truth in that because it's undeniable that there are plenty of traders who just trade technical analysis and who are very profitable. I know many of them, so I'm not saying that you cannot be profitable if you only know technical analysis. I also know traders who are very profitable by really only looking at the fundamental side of it. So you definitely can just do one or the other. However, I personally believe that if this is something that you're taking very seriously and this is the thing that you want to do for your job, often when traders come to trading, they do it with the intention of making significant money. And I honestly believe that if you want to do a high skilled job where you earn a lot of money, you kind of want to be looking at it from all angles and you want to give yourself as much of an advantage as possible, especially when the stats are stacked against you. So statistically, you're not likely to be a profitable trader, unfortunately. If you look at the little risk warning down at the bottom, around 75% of traders who trade CFDs actually lose money. So if you want to give yourself as good a chance as possible of being a profitable trader, I would say that you need to understand both technicals and fundamentals, even if it's just fundamental analysis at a basic level. So this video should help to give you that knowledge, even at a basic level. Even if you don't want to continue with it, this should help you to give you the basics. However, I do actually recommend that you take a bigger deep dive into it. If I'm being completely honest, I would say once you've finished watching this video, maybe do spend a little bit more time actually practicing going over the tips that I've shared at the end and trying to get a little bit more fluent in fundamental analysis, because I do honestly believe it will make the world of difference to your trading. One of the biggest reasons why I think that you really do need to understand both is because fundamentals will always override technicals. What that means is if there is a lovely chart pattern which looks a little bit bearish, but the data comes out, the news releases come out, and it's bullish, that's always, 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 always going to override the little chart pattern you saw. If the RSI says something is oversold, but the news data comes out and it's very bearish, the market's still going to go down no matter what your indicator said. So technical analysis is often a visual representation of past data, but it's not giving you any information as to what's going to happen next, whereas fundamental analysis can tell you what's going to happen next. Let's just take a really extreme example. When the pandemic hit, we had a huge stock market crash. That was moved because of fundamental factors. So it doesn't matter what candlestick pattern you saw approaching that big crash, the market fell because people removed their money from the stock market because they were afraid of a crash. They were afraid of the uncertainty that lay ahead because there was a global pandemic. That is what moved the market. So technical analysis will get you so far, but you also need to understand what's really moving it. So I imagine that when a lot of you were first starting out in trading, the advice that you're often given is don't trade on news days. And a lot of the time, we really run with that because it sounds a lot easier to not do something, especially when it means not learning something that we think might be difficult. So I remember that was the advice I was given. Don't trade on news days, don't trade on NFP, don't trade on interest rate decisions, don't trade when you don't understand what's going on. Great advice not to trade when you don't understand what's going on. And also great advice not to try and learn too much at one go. So, if you want to start learning technical analysis and then add fundamentals in later, that is a way of doing it. But I think what happens with a lot of traders is that they hear that information, that advice not to trade news days, and they kind of run with it a bit too far, and they never pick it up. Obviously, if you're watching this video, you're not one of those people because you've decided to pick it up. It can also help you understand when not to trade, which is really important because a lot of the time there are going to be entire days when you shouldn't be trading at all. And if you understand fundamental analysis, it can sort of point you in the right direction of when not to trade. It will also help you spot unicorn days. That's a name that I've created for when the market makes really, really, really big moves. You only get a handful of unicorn days in the year, really. I mean, we're talking about maybe 10 in the whole trading year. Things like the pandemic, Brexit, or Liz Truss's budget. I know I've just named a whole bunch of really awful things there, and then I've given it a cute name like Unicorn Days, but ultimately it can be good things as well. But it's when something unexpected but really big happens and you have this huge move in the market. Those days are quite important in trading because you can make about 10% in one day, in one trade. So if you understand what these events are and how they're likely to affect the market, it will give you the confidence to stay in them for a really long time and to hold your trades for a long time. It will also help you know when you should reduce your risk on a trade and what time of day you're likely to get the big move at. So understanding fundamental analysis, I believe, is very important for your trading. So beginner's cheat guide to fundamental analysis. The important economical events, I've used the shortened versions of these. So NFP is non-farm payroll. It is economic data which comes out usually on the first Friday of every month. It mainly affects the US markets because it's US data. However, it will affect everything. So you want to be aware that on the first Friday, usually, sometimes it's the second Friday, but usually it's the first of the month at 1:30 UK time, there is going to be an enormous piece of data that's going to come out and it's going to cause a huge spike in the market. And the market is also likely to react very heavily from that moment on. So what's very typical on an NFP day is that there are very, very small candles. They're not really doing much. And this is what's happening before the news release. And that's because no trader wants to make a big decision just before a news release comes out. They want to be making the decisions afterwards. So at 1:30 on the dot to the second the NFP results come out, that's 1:30 UK time, there will be a huge move, a huge spike, and that injects this huge amount of volume into the market. The rest of the day, the rest of the trading day is likely to have a lot of volume in it, but before that moment, you're likely to have very little volume. You're also likely the Thursday and the Wednesday before NFP. Often it can be difficult to get a good position, so your strategy may not actually work the same the 2 days before NFP than it does usually. So if you've just been stopping trading on NFP but forgetting about the 2 days before and often struggling on those days, then that could be a reason why. A lot of people know not to trade on NFP, but they don't necessarily know not to trade the morning before NFP because the market's unlikely to be making a big move, but also the 2 days before that as well. CPI, Consumer Price Index, this is a measure of inflation. You get this happening about once a month, and it will be happening across most currencies. It's a measure of inflation that's going to affect the interest rate decision, which is what IRD stands for. And these are really important pieces of economic data because the interest rate makes a huge difference as to whether the stock market or the currency is high or low. The reason for that is because interest rates are fixed. So if you have an interest rate on a savings account with a bank, that rate is fixed, and that's fixed based on the interest rate decision. If the interest rate is very high, we've had it be very high recently in the UK and obviously in the US as well, and that was following the pandemic and the high inflation that happened. If the interest rate is very high, then people are more likely to keep their money in a bank account to get that guaranteed interest. So 5% is very high, and it has been 5% recently. And getting a guaranteed 5% of your money back in interest just for keeping it in a savings account, and that's guaranteed, plus your money is safe on the whole in a bank account, that's considered to be very attractive, and people are more likely to be putting their money into their bank account and therefore increasing the value of that currency if the interest rates are high. So when an interest rate decision comes back and an interest rate has gone up or it stayed high, you're more likely to see the currency being high as a result of it. But often, I've put that as my second point, good for the dollar, bad for the stock market. If a piece of news data is good for the currency, let's say the dollar in this instance, because that's what I trade, if the interest rates are high, you're likely to see the dollar make a move up. However, you're also likely to see the stock market make a move down, because when one goes up, the other goes down. That's because the stock market is another place where people will invest their money. And it's very much the opposite almost to a savings account, to a bank account, because the stock market is very risky, whereas in the bank account, it's very low risk. Like you're almost always guaranteed to get your money back. Occasionally a bank will close down, but that happens so rarely. You're almost guaranteed to get your money back from a bank account. Whereas the stock market, you can potentially lose everything. They can go to zero. So the stock market's seen as risky. However, the stock market often offers a much higher rate of return than a bank account. And it's often way above that 5%. I mean, it can be 10%, but it can be even more than that. So the stock market, or the indices, which is effectively the stock market, they're very good for traders or investors who are a little bit happier to take that extra risk and get that slightly higher return. But obviously there is the risk of it going to zero. So when interest rates are really low, people will be more inclined to put their money into the stock market and to make the most of the potential higher returns and take on that risk of a stock market crash. Whereas if the interest rates are really high, people are more likely to take their money out of the stock market, not to risk that crash, and to instead guarantee that their money is safe and get that guaranteed rate of return. So you will often see one going up as the other goes down for that reason. And CPI will often be the thing which will determine the interest rate decision. So you'll see them very much having the same result. If CPI is high, that means inflation is high. That means interest rates are likely to stay high or be raised. Both of those will be good for the currency, but not necessarily good for the stock market. If NFP is high, again, that's good for the currency, not so good for the stock market. I put CBS on there. It's a central bank speech. You get these randomly throughout the month. You really want to be aware of when the central bank speeches are, because I would say don't trade at all. When the central bank speech, I'll actually put a little vertical marker up on my trading view which says stop trading. It's to remind me to come out before the central bank speeches. Central bank speeches often cause a lot of fluctuations and a lot of random moves because people are listening to them live, and often it's a mix of good, bad, good, bad, good, bad, and the market's going wild. So I would highly recommend not trading when the central bank speeches are happening. Other things to be really aware of are the election cycle and who's in power. Often the election cycle is 4 years, and who is in power and what their policies are will make a big difference as to the long-term directions. Often with the US election cycle, you tend to see a bit more of a push up in the stock market on the approach to the election. So the 2 years before the election are more likely to be bullish on the stock market, whereas the 2 years afterwards are more likely to be bearish. Obviously, this isn't a hard and fast, and it will depend on who's in power, what policies they've brought in, and what their stance is. So Donald Trump, who's currently in power, is a Republican. It's the equivalent of conservative in the UK. They're both seen as being hawkish, which means that they're often looking after the currency and the wealth, and a lot of the time it can be seen as looking after the wealthy and keeping the country rich. Whereas the Democrats, which is what Biden was, is the equivalent, is the similar-ish to Labour, which is currently in power in the UK, and that's seen as being more dovish. That's being less concerned about making the rich richer and more of a distribution of wealth and looking after public services. Some people view it as being a little bit kinder to the majority of people, but it can also be seen as being weak for the currency itself. So often the Conservative governments and the Republican governments will see the currency being strong, and they'll often make moves that make the currency strong, but that will sometimes bring down the stock market. Whereas it's the other way around. So when the Democrats or the Labour come into power, you can often see more of a move up in the stock market and a move down on the currency. So you'll notice that when Biden came in, there was a huge move up on the stock market, on the US 30, on the NASDAQ, and it more or less continued to go up for 4 years. And when Donald Trump came in, there was a huge move up. We had that big push on election day. But since then, it has kind of settled a little bit. And it wouldn't be the most surprising thing in the world if it did start to make a slow move down. Obviously, this will all depend day to day, week by week, what actually comes out, what their policies actually are, what comes out of any news releases that are released, but it wouldn't be surprising if that happened. Uncertainty and certainty also play a big role in where people put their money and how the markets move. If people are feeling uncertain about a political party, you might see that the currency comes down and the stock market perhaps moves up. Think Liz Truss's budget. Great example. Lovely unicorn day. She made one of the most catastrophic budgets of all time. It's almost comical how bad it was. And that saw the pound absolutely plummet. When people are feeling uncertain about who's in charge and the policies that they're bringing forward, you're likely to see that currency dropping. We also had a similar thing when Brexit was voted in. People were feeling very uncertain about that, and you saw the pound drop. So just being aware of who's in power, what their policies are, and how certain people are feeling will help you with your directional bias. So 5 fundamental trading secrets which will help you on your trading journey. So the first thing I would say, if you are an indices trader like I am, one of the best things you can do, although it's going to be really boring the first time you do it, is actually memorize the companies as best you can of the indice that you are trading. So the US 30 is quite a nice one because there's only 30 companies. But if you think that that market is literally made up of 30 companies, so it doesn't matter. I've said this before about how fundamentals will override technicals, but I'm just going to say it again because it makes a really good point. It doesn't matter what candlestick pattern you see on the chart. If those 30 companies are doing really well, you'll see that market go up. But if you memorize the companies, You only have to do it once and then they're stuck in your head, and it's going to make it so much easier for you when you start to see them popping up in the news, or you start to see any information coming out about them, or you want to spot when it's their earnings day. For example, in the US 30, Coca-Cola is one of the companies. Let's say Coca-Cola has a really bad day, something bad happened, or something really good happened. They're in the news for whatever reason. Because you know that they're one of the companies in the US 30 and that's a market that you trade, you're going to be really aware when you see these companies in the news. And because they are the biggest companies, they're very, very often in the news. And it can be really obvious when something's good or bad and how that's likely to affect the market. And that can be really helpful for you to establish your directional bias before the market even opens. Also, very similarly, if you are an indices trader, you do want to be aware of the days that the earnings reports are coming out for those markets. Again, US 30 is quite a nice one because there's only 30 companies. NASDAQ, I also trade that, but there's a lot more. There's 100 companies. So it's a little bit more work, but it's a lot easier to spot the US 30 ones. You want to be aware of the days that they're coming out. If it's coming out before the market opens or after the market's closed. And if it's before the market opens, you can actually Google the company and then go to the news tab on Google. Usually when you type something into Google, it comes up with all on the side, you know, along the top where you select it. So it's all news, images, and then a few others. If you click on the news tab, you'll see the news reports that that company has released. And often you can get a much more colourful picture of what they've released rather than just the number. A really good example is that Walmart recently released a 3% surprise on their earnings report, which on paper looks okay if you just looked at that figure of 3% surprise. But if you went in and Googled Walmart and then went to the news tab before the market even opened, you would have seen that actually they reported very, very pessimistic projections for the upcoming quarter, and they actually believe the earnings were going to slow down and get worse. The market then opened on the New York Open and it absolutely crashed down. It was almost a unicorn day because we had, I think it was 500 to 1,000 points. I don't know exactly off the top of my head, but it was a huge move that happened and it absolutely crashed down. And if you just looked at the number itself, you wouldn't have got the full picture. You might have thought that your directional bias was bullish. But if you go into that news tab and you see what they're saying on the day that they release their earnings, you're going to get a much clearer idea as to what's actually going on. The other thing is you want everything to be in alignment. So you want the long-term direction and the long-term momentum to be in alignment with the data that's coming out. So when you have, say, really strong bullish momentum on the day chart, but a negative earnings report that's come out, you're going to see the bulls and the bears really, really fighting. You're going to get these really giant pullbacks and very difficult moves, which makes it very difficult to get a good risk to reward or a really good entry. So ideally what you actually want is you want the earnings reports or the economical data when it comes out to be the same as the long-term momentum on the day chart. On those days when everything's in alignment, you get a much nicer move and it's a lot easier to get a good trade. If they're not in alignment, I will often choose not to trade at all. News pop-ups are really, really helpful. My favorite place to get news pop-ups is Bloomberg, but to be honest, I've got them on most of the news stations. I've got BBC, I've got Sky, I've got Apple News and Bloomberg as well. And I set the pop-ups to come up on my phone so that I'm involuntarily, against my will, being fed all of the news releases. I know a lot of people hate this and a lot of people don't like to see news releases when they come out. My background is actually in broadcast journalism, so having news pop-ups is quite normal for me, and it's something that I've always done just so that I can keep on top of what's happening. But it's particularly useful on Bloomberg because you're constantly being told what's happening and you're constantly being updated with the latest information. And so many of the times when I've managed to spot a unicorn day has been as a result of getting a pop-up from Bloomberg and seeing that information before the markets even opened. Sometimes you'll see how the European markets reacted in the European session, and that will come up before the American markets are open, and that can be really helpful for where you're looking, what you're looking for, and what your directional bias is going to be going into that session. So I highly recommend signing up to Bloomberg and making sure all of your notifications are on. News events also make really good key levels. So on NFP, CPI, and interest rates decisions, you want to mark up the bottom and the top of the big move that happens immediately as the news is released. I use the 1 minute chart to do this, but you really want to get the very bottom and the very top. Often you'll see there's a lot of wick approaching it, so you want to get the wicky part of the top rather than the body of the candle, if that makes sense. So if you have a huge momentum candle moving up on the 1 minute chart, and then there's the second minute, there's another candle moving up, but then it wicks and comes back down. You want to use the top of the wick of that second minute on the candle rather than the top of the first minute. But if the whole move happens in that first minute and then it comes down after that, you use that top of that first minute. So you want to mark up the high and the low and just write on it CPI March or NFP April. And you will find that these make excellent key levels for up to about 8 weeks afterwards. So the market will often come back to these points and make really nice reversals. So these can be excellent places to get in, but also to get out of trades going forward. You can also use these for the random events that come up. So for example, recently we had, when Donald Trump announced all of those tariffs that he was bringing in, we saw the market absolutely plummet and shoot down. And at the bottom of that day, so if you have a unicorn day, this is when the market will move about 500 to 1,000 points on the US 30 in one move. When you see a huge move like that based on a news event, if you mark up the bottom or the top of where the market's reached and then mark it up what that news event was, you'll see on the following weeks it will keep coming back to that point. And again, it can make a really good place to get into but also out of trades. So well done for making it to the end of this video. As promised, you have a free gift, which is the Economical Calendar cheat sheet. I make one of these and I print it off and keep it at my desk every single month because it's just really helpful to see at a quick glance what days the news releases come out on. I actually make notes on mine, so I'll make little notes on mine. So for example, as I told you, NFP usually comes out on the first Friday of the month, but the day before and even the Wednesday before, you're still likely to see some unusual moves. So I'll still make little notes on mine from the Wednesday, I'll say 2 days before NFP, 1 day before NFP. So it just helps to remind you that you might have difficult conditions on those days. If we're still in March when you're watching this video, then you can email and you can get the March version. But if we're already in April when you email, I will send you the April one instead. Hope you found this video helpful. If you did, make sure you give it a little thumbs up. It's good for the YouTube algorithm and it means I can continue to create this free content for you and it will help reach more people.